Hello, everyone, and welcome to this panel discussion on navigating the new landscape of foreign direct investment. My name is Jacopo DETTONI. I am the editor of FDI Intelligence, the investment monitor of the Financial Times in London. And more importantly, today I'm honored to be a guest of YASED International Investment as a moderator for this panel discussion. Needless to say that COVID-19 has really wreaked havoc across multiple industries, while also creating new opportunities along the way. Think of this event. COVID-related restrictions heavily disrupted aviation and hospitality, also preventing most of us from gathering physically for this summit. At the same time, it gave providers of digital services a once-in-a-lifetime chance to shine. And here we are connecting digitally from all over the world. However, it is not a zero-sum game. Not yet, at least. The shock has been more acute than the remedy. Global investment activity is down by somewhere around 33 to 40% this year and may fall even farther next year, although estimates may be revised upwards depending on the pace of rollout of effective COVID vaccines. The pie is shrinking, investors are flying back to the safety of their own countries or regional blocks, and competition between investment destinations is heating up. What does it all mean for investors and for policymakers? I'm glad to be here digitally with three exquisite thought leaders in the world of global investment that will help us answer these questions. They are connecting from different parts of the world, so let me briefly introduce them before getting into the discussion. Connecting from Vienna, we have Wiebke SCHLOEMER, the Director for Europe and Central Asia at the International Finance Corporation, or IFC, the private investment arm of the World Bank. Connecting from Washington, D.C., we have Caroline FREUND, the Global Director of Trade, Investment and Competitiveness of the World Bank. And last but certainly not least, connecting from Geneva, we have James ZHAN, the Director of Investment and Enterprise at the United Nations Conference on Trade and Development, or UNCTAD. So welcome everyone again, and let me start with you, Ms. SCHLOEMER. You lead the IFC's operations in 24 countries and have over 20 years of experience with investment in emerging markets, supporting companies to grow and maintain sustainable value, both through direct investment and working with private equity funds. How many times, Ms. SCHLOEMER, we have heard in the past few months that this crisis has been unprecedented? And I guess that we all face unprecedented challenges and adjustments as individuals, family members, and citizens. But what has it all meant for private investors? And what are the complexities for them when it comes to navigating the current investment environment?
Very good. Thank you, Jacopo. And first, let me tell you how glad I'm here glad to be joining today. And I'm very grateful for YASED for inviting me. And if I may say, that's for two reasons, because Turkey is a very important country for the IFC. It's actually our second largest portfolio of investments globally. And also for me personally, having lived in Istanbul for 6 years. And like you said, I really wish we could have met in Istanbul today in person, but looking forward to when we can travel again and meet. And as you said, it's been an unprecedented crisis. And I think we know the overall picture that COVID-19 has really delivered an enormous shock to the global economy. And I always look at it, and that's what we've seen from our companies. It's both a supply and a demand shock, which means, and it continues, for companies, for investors, we've seen disrupted supply chains and disrupted demand. With this came the impact on production delays. As a result, we see revenue shortfalls and that puts pressure on liquidity. You have, and that's, I think, a new dimension in this, you have tremendous health and safety concerns for the entire workforce, which again puts a lot of emphasis and focus on business continuity challenges. It comes with delays in conducting business, adjustments to the way of working. We know it we know it firsthand for all of us, but really for companies depending on businesses, adjusting to conducting business virtual, to working from home, that again put tremendous pressure on IT systems, on digitalization, and a lot about concerns and unclarity about government or public support compensation schemes, for example. So what makes this crisis and these challenges so complex is that we've seen the private sector encounter some of these before, but all together, all the different challenges across all dimensions, this is really unprecedented. And what it brings in particular is unpredictability. That's a theme that I hope, or I would like to pick up again later, because whenever we see unpredictability for private investors, this leads to prudent approaches, to slow down, to a flight to safety. Let me stop here, but again, the complexities are quite unprecedented.
That's fantastic. Thank you very much, Ms. SCHLOEMER. I will definitely have a chance to pick up on that unpredictability element later on during the discussion. But let me now bring in Ms. FREUND, and let me widen also the perspective with you, Ms. FREUND. Last year, alongside your colleagues at the World Bank, you have led this incredible effort that culminated in the latest World Development Report, which had a specific for global value chain. An incredible piece of research that I recommend everyone to have a look at. And it really kind of like digs deep on the nature, the depth and breadth of global value chains. Global value chains have been a big topic of discussion since this pandemic struck. We have heard a lot of analysis that as a result of the pandemic, global value chains will become shorter, will be restructured, and so on and so forth. But my personal feeling is based on just anecdotal conversations and some evidence that I gathered, is that global multinational companies are still in a sort of wait and see mode, that they are still reassessing their strategies. And even if this adjustment happens, it will not definitely happen overnight. And maybe in some sectors, it will not happen at all. So what is your perception of the kind of adjustments that we have seen in global value chains so far? And what do you expect moving forward? Thank you.
Yeah, thank you very much. And actually, the last trip I took before the crisis hit was to Istanbul. So it's nice to see you again here. So trade supports income growth. We know that. And it does so even more so through global value chains. They have two really special features. One is hyper-specialization. Countries can find one thing they do really well and benefit from returns to scale. The other is via foreign direct investment and firm-to-firm relationships that transfers know-how, it transfers technology. And what we find in that report is that GVCs are about twice as important for growth as regular trade. And there was this huge economic revolution in the 1990s and early 2000s where GVCs were formed, trade was growing about twice as fast as income growth. Incomes rose around the world. Developing countries began catching up with rich countries in terms of incomes, and poverty rates plunged. And today, roughly 50% of trade involves global value chains. But this expansion already began slowing after the global financial crisis. It slowed in part because there were no major liberalization agreements. It slowed because growth was slower. And then in recent years, trade tensions added to this uncertainty that Wiebke also mentioned. So then what happened? Now we're in this huge shock with COVID. And there's a couple points I want to make here around GVCs. First, there was a lot of concern around GVC disruptions. And there were disruptions, no doubt. But in many ways, trade and global value chains have actually held up much better than income. In fact, if you look at trade now, it's at roughly the same level it was at the same time last year, global goods trade. In East Asia, it's even above where it was last year. So we're seeing trade return. We heard from some of the biggest companies like Mercedes and Samsung, that no major GVC disruptions happened, such that, you know, a car wasn't built or a phone wasn't made. So trade has recovered, but it's been very uneven. So, but the regions that are held back are actually the regions that are less integrated in global value chains and less integrated in trade more broadly. Sub-Saharan Africa, South Asia, and LAC. Those are the regions, Latin America and the Caribbean, I mean, those are the regions that are really being held behind. We did see shortages in essential medical goods, but that's in part because you had this surge in demand and there are capacity constraints. And then the final point I'd like to make is about services trade. And that's where we see a really big difference. So during the global financial crisis, services trade actually was more resilient than goods trade. This crisis is flipped. Services trade is being hit much harder as a result of the sharp decline in tourism, of course, an industry that also affects Turkey. So international tourist arrivals are still down about 80% as compared to the same time last year. And let me stop there. Thanks.
All right. Well, thank you, Ms. FREUND, for this insightful comments and introducing this element of an uneven recovery in global trade, particularly not just on a geographical level, but also between trading goods and trading services. And we can come back to this later. But let me now bring in Mr. James ZHAN. James has been researching and exploring the world of global investment for 30 or even 40 years, correct me if I'm wrong, James, and you have experienced and studied the great expansion in global trade and investment that Caroline mentioned in the 90s and the first decade of the 2000s, and then also that period of sort of stagnation in the past 10 years. What is your assessment of what we are facing at the moment from a perspective of global investment? What is your outlook? What are your estimates? And what do you see in the foreseeable future? Thank you.
Thanks, Jacopo. Obviously, the pandemic is a triple shock of supply, demand, and policies. It has a severe impact on investment. It's very interesting to hear Caroline's perspective on trade and the GVCs, particularly this services trade, trading services. Clearly, there is a difference between trade and investment in this crisis. Trade has been weathering the storm much better, as Caroline said. But in terms of investment, it is a gloomy picture. in a sense, according to our forecast, the global FDI is likely to decrease by up to 40% this year. And that's from 2019 value of $1.5 trillion US. And this would bring FDI below 1 trillion for the first time since 2005. The global FDI is projected to decline further by 5 to 10% next year. And the gradual rebound of global FDI would probably start in 2022. And this would show a kind of U-shaped recovery. This is unlike the trade, as Caroline highlighted. So that's a bit of worrisome. But overall, the outlook for investment is highly uncertain. Prospects depend on the duration of the global crisis and effectiveness of policy response. The important thing is that geopolitical conflicts, financial risks, and the trade tensions may add the uncertainty. That's what we feel. Now, the current crisis affects FDI in different regions in different degrees. The FDI flows to developed economies, according to our projection, may decrease by 30 to 40%, while for developing countries, it's 35 to 45%. Transition economies will hit the hardest. But having said that, when we look at the first half of this year, and in fact, developed countries suffered the most. They had a reduction of over 70%, 70%. And developing economies weathered the storm better so far, and declined by only 16%. And it was mainly because of the developing Asia has been doing well, and they suffered 12% of decline. This is what Caroline said, that they led started a recovery, so to speak. But having said that, looking at the greenfield investment and project finance deals, these are the indicators for the future investment flows. And for the first half, for developing countries, the decline is over 50%. So that shows maybe for the second half of the year, developing countries will suffer more. And therefore, over the whole year, we still believe global FDI will decline up to 40% for the whole year. And this looks very gloomy picture, but we have a positive note. The positive note is that despite the drastic decline in global FDI flows during the crisis, the global FDI stock remains at the level of $37 trillion US today. That counts for over 40% of global GDP. And for developing economies as a whole, their total FDI stock amounted to 11 trillion, is equivalent to over 30% of their GDP. Therefore, it shows that FDI will continue to play an important role in global economy and development. I'll stop here.
Thank you, James. Again, very few interesting elements you threw in, and I will definitely touch upon a few of them. A few of them in much depth. But let me pick up this dichotomy between the developing and developed markets and investment destination. I think that from our own observatory, we also FDI intelligence, we gather data on greenfield for investment. We have witnessed in the past 2, 3/4 months an increasing sort of like flight to safety, or at least data seems to be consistent with investors from, for example, from the US, being particularly focused and active in domestic investment as opposed to overseas investment. And the same, we have seen the same sort of similar trends within blocks. European investors being particularly active in investing within the European Union, or at least within OECD countries, so to say, where they can be more familiar and they can navigate the investment, the investment environment with more predictability. So Wiebke, my question for you would now be, what are, within this context, first of all, do you also perceive that there is a sort of like flights to safety? Often we talk about flight to safety when it comes to financial investment, but do you perceive that there is a flight to safety also in the case of a more direct greenfield or brownfield investment? And if yes, what are the challenges for developing countries, and how can developing countries, particularly those that are not that connected yet with global value chains, have to deal with to remain relevant in the global investment arena?
No, thank you. And I will say also, hearing the data from James, it's data I was aware, but hearing it again, indeed, sort of, I think, underlined the gloomy picture and the challenges we have ahead, especially those of us focused really on developing countries, emerging markets. A couple of thoughts on this. First, actually, already pre-COVID, what we've observed is a trend towards, I want to say, protectionist sort of measures or protectionist tendencies. For example, we've seen 9 out of 10 of the largest economies have changed their rules on foreign takeovers, and very much to fend off risks on national security. And of course, this has then also extended to smaller economies, to emerging markets. Linked to this, in a way, we observe an apprehension of new threats, often related to digital activities. So this is already a trend we've seen, and now with let's say the flight to safety in particular, I want to say often a rethinking of where to invest. Also for greenfield investments, reassessing of supply demand. Does the investment thesis still hold, or at a minimum delays? And with this in mind, going forward even more, we expect emerging markets in a way need to be really competitive and need to compete to attract FDI. And one theme that I mention consistently, and I saw in the 2019 Global Investment Competitive Survey, actually summarizing it quite well, what can help or what's critical to attract high quality FDI. And it is a lot around the theme of stability and predictability. So this is, you see, this is something for the evidence I keep referring to. And a few topics there are a stable domestic policy, very much with an emphasis on political and macroeconomic conditions. This plays a critical role. And there again, evidence shows that key elements of a stable political environment include strong institutions and predictable policy making. Macroeconomic stability is also vital, and it's centered usually around implementing macroprudential policies, central bank independence, and let's say an optimized and supportive fiscal policy. So these are really key themes. Providing this type of predictable and supportive legal, regulatory, and institutional framework is critical to attract FDI. Now, as sort of, I think we're all learning still about the COVID impacts. I feel it's a constant reassessing, and there may be new opportunities for governments, as we might see shifts regionally where companies will put emphasis on, and also sectorally. For example, opportunities that may arise from a strong focus on e-commerce, on digital activities, while perhaps less demand in, let's say, natural resource-driven FDI. So these are possible themes, but to be continuously reassessed. And there's one more theme, how I often phrase it when I think about creating an attractive environment for FDI. It's having a convincing story. In a way, you need a lot of ingredients, but then the different ingredients form sort of a story, and again, a thesis for FDI. Is it a large domestic market? Is it a strategic location? Is it other natural resources? So being clear about the story and then providing the different, as I say, ingredients from the framework perspective with predictability will very much help in sort of recovering or attracting FDI going forward.
Fantastic. Maybe just a brief follow-up question to this very last point. As I mentioned in the beginning, you oversee the IFC's operations in 24 countries across Europe and Central Asia. Do you believe that coming up with a compelling investment proposition, a compelling story for investment remains a bit of a challenge for countries across the developing country economies space?
I think it is, yes, it can be challenging. I think we see countries that do well with this and the story, but it's also, I would say, usually not static, complexities, both macro, but then also political complexities and stronger ties with, regional, global integration in other countries, the sort of the surrounding countries. I would say it is challenging, but again, and I think we will later touch upon Turkey also. It'll be interesting to think about, what's the story for Turkey.
Okay, that's fantastic. Yes, definitely. It's not just about a static story, but a story that can also evolve according to the market circumstances. Caroline, let me go back to the idea of value chains and the regionalization of value chains. We have seen over the past 10, 20, 30 years, the emergence of these trading blocks that have been strengthened or adjusted over the past, also very recently. Think of NAFTA with that now it's called USMCA, and now we have seen just last week or a couple of weeks ago RCEP in Asia, big trading bloc bringing together not only the usual suspects of Korea and South Korea and Japan, but also China now and all the ASEAN countries. So do you believe that we are going towards a regionalization of global value chains, also in the perspective of making them more resilient, as we have heard often in the past few months as a result of the COVID pandemic? And what does this mean for those countries that have tried to connect better to global value chains in the past, and now maybe they find a kind of like a smaller audience for them to pitch their global value chain proposition?
Yeah, thank you very much. So that's been a really big question right now, this issue around the reshaping of global value chains. And maybe first, to go back to your question about the regionalization of value chains, it's interesting because some value chains are more regional than others. So Europe is very regional. NAFTA, while there's a regional element to it, is still a very global value chain in the sense that a lot of value added comes from other parts of the world. And if you look at how value chains have been changing over time, it isn't really the case that they've been becoming more regional. They've been both globalizing and regionalizing. It's just less domestic value added in trade. So I think when a country thinks about liberalizing, actually they want to open up in an unbiased way, because as soon as there are preferences, there are distortions. So the best you can do is open up in an unbiased way. Geography, of course, matters. It's good to be near a big market because that's a bigger market for your goods. It's a bigger source of inputs for production and goods for your consumers. But in terms of policy, it's good to really keep that as unbiased as possible. In terms of the reshaping of global value chains, we'll see, and time will tell. There are a few points I want to make here. One is, and I think James mentioned this as well, it's not going to be immediate. And especially in many goods, we're in a position of overcapacity right now, because while trade has recovered, it's still nowhere near what it would be had there been no crisis. So there's no growth in it. It's just, recovered, and in parts of the world it hasn't. And as a result of excess capacity, it's unlikely investors are going to be looking for new places to expand capacity. Then there's all these uncertainties that both Wiebke and James have talked about. And in an environment of a lot of uncertainty, there's one dominant strategy, which is to wait and see. Let's see what policymakers decide to do before I make this investment that's going to be sunk. Let's see what's going to happen. Is this how long the crisis is going to be? How strong the recovery is going to be? We don't even know which sectors are really going to expand a lot and which sectors may really contract. So there's going to be this period of kind of wait and see before we see this reshaping. To the extent it is happening, it's being driven much more by policy concerns than by natural economic fundamentals. So policy concerns about what might happen between China and the rest of the world, this concern about over-reliance on China as a place of producing. So those kind of concerns may be driving investors to think about moving some production, especially where wages were already rising, in sectors where it already was becoming unproductive to produce there. It makes sense to expand elsewhere, but it's not going to be a rush, in my view, out of reshaping these value chains.
And this goes back also to the idea that for many things, COVID-19 has just accelerated some of the existing unfolding trends, and we were already experiencing a big outflow of investment out of China into places like Vietnam or Bangladesh, for driven mostly for cost considerations, and maybe now there is also an element of a more strategic element of making your China plus one strategy, or leaving China altogether within a perspective of resilience. But it's interesting also that some of the countries that on a macroeconomic perspective seem to have been coping with the storm better are not only China, that next year is expected, according to IMF data, to rebound to 7-8% of growth. So even faster than the new normal of the past few years. But also Vietnam, for example, is expected to rebound very, very strongly, and also this year is still growing. And I say in Bangladesh, countries that maybe at the beginning when COVID hit and there was this element of total disruptions in value chains, people would have not have expected them to be so resilient. But now, maybe also because of what you said at the beginning, yes, global value chains have been disrupted, but just so much, and disruption has not been widespread even, and obviously sometimes, as in the case of PPEs or medical equipment, has been caused by an incredible spike in demand. But probably we can go back to later to some of these points, and also to the predictability, policy predictability element. But James, let me address a very final topic of discussion that has dominated the headlines in the past few months, which is green growth, sustainable investment. Now there seems to be an incredible consensus across governments in the developing and developed market world that the economic recovery has to be inspired and driven by sustainability, by complying with a high ESG standards. And combined with this idea that expansionary policies will continue is probably going to lead to a lot of incentives for things like renewable energies or any forms of so-called green growth. But I know that you also have a particular take on this. You believe that the ongoing process of deglobalization doesn't really combine well with the idea of sustainable investment. So do you want to give me a few insights into what is your own perspective on this particular topic?
Yeah, thank you, Jacopo. Before I talk about the sustainable investment, I just wish to highlight what has been said. I heard very interesting, trying to put what you and Wiebke and Caroline said. You said that your observation is that domestic and intra-regional investment quite active, according to your data on the green and brown deals. And then I think Wiebke mentioned about protectionism and mentioning quite a number of countries have put in place this tighter screening and monitoring mechanisms. I think that explains why intra-regional and domestic are more active than cross-regional or inter-regional investment, because all these screening and monitoring are geared towards outside regional blocks kind of screening. And I think Caroline mentioned a very interesting point, this excess capacity. That can explain perhaps why investment is lagging behind in terms of recovery. At least is one of the major reasons, on top of what she said, the policy concern is overshadowing other factors. So I think this is an interesting thing to capture, which is very nice that I got from this conversation. Now, regarding this sustainable investment, I think in 2014 we came up with the assessment of 1.5 trillion US dollars, 2.5 trillion US dollars annual gap for developing countries to achieve the SDGs. And recently we have done a kind of assessment 6 years into the implementation of SDGs. And in fact, 6 out of the 10 SDG sector groupings covering 17 goals shows that they made progress in increase in investment in SDGs. That covers both domestic, foreign, and public and private investment. I'm talking about total investment. But having said that, putting together this progress is still far from enough to fill in the gap of 2.4 trillion US dollars. Having said that, we also looked into the sustainability financing. The sustainability dedicated funds increased rapidly over the past few years. It reached, according to our estimates, is 1.2 to 1.3 trillion US dollars now. That includes 260 billion US dollars of green bond, 900 billion sustainability dedicated funds, and 105 billion of social bonds. And this COVID-19 response-related social bonds increased very rapidly. And for the first few months of this year, it reached 55 billion US dollars. It's more than the whole year of 2019 social bond. So the fund has been increasing. But having said that, all these are located in the north, in the renewable energy, in the green climate change related sectors. It hasn't flow in a significant way to the south, to the SDG sectors, and to generate impact. So there's a dilemma. On the one hand, the rapid growth, on the other hand, not even reaching the SDG sectors in the south. I think there are two sets of challenges. One is the policies. We did a survey of 120 plus countries, their SDG implementation strategies. And after that, very few papers have concrete measures for promoting investment into SDGs. We also surveyed national laws and regulations and the regulatory framework, including investment promotion strategies of 105 countries. And that survey shows few countries really have a kind of sophisticated or kind of solid scheme of tracking investment into SDG sectors. It is not, it's just a general investment promotion and mentioning sometimes in a few cases that SDGs. So, and even for the incentive schemes we surveyed, very few SDG sectors were covered. Education, health, and for example, these are not covered by the incentive schemes of many countries. So this is a kind of interesting phenomenon we see. It's quite challenging. We understand that countries have the responsibility to ensure goods and services provided by private sector that needs to be affordable and accessible by the poor. So they regulate all these sectors, so-called public services. But in the meantime, SDGs encourage private sectors to move into these areas, and these areas are not open to private sector and foreign direct investment in particular. So all these health, education, sometimes critical infrastructure and parts of the agriculture. So that's the dilemma that we need to face. The second set of issue is the capacity of these developing countries to prepare bankable project pipelines. They don't have the capacity, and we often hear that all these investment funds and the fund managers saying that where are the SDG pipeline projects for us to invest? So that becomes another problem. Therefore, there's need to address the challenge both at the policy front and at the capacity front to build the capacity. I think that World Bank, IFC, should shoulder more than UNCTAD. We're a small organization, but we try also to do our part.
Thank you, James. I understand, Wiebke, do you want to add anything to what James has just said?
Yeah, actually, two thoughts. First, one more. I keep still reflecting on one thing Caroline said, and then now we'll come in also on James' excellent sort of overview. And Caroline, I think it's so spot on to say a big theme is right now among investors and private companies, wait and see, in light of existing overcapacity and uncertainty. And sort of another dilemma, or at least a question to focus on, is if this happens at a time and going forward when actually private sector investment will be needed even more. And I'm saying this in light of the huge constraints public budgets will experience or are starting with. It's not rocket science. There's so much public debt going up. Budgets will be constrained. So whenever possible, the hypothesis is there will be actually a need, let's call it, for PPP projects. Whenever the private sector can be brought in, it's important to mobilize and again make it attractive to bring in the private sector. Of course, it needs to be done in a sustainable way, and that at a time when there's caution prevailing. So this is something I think we will all need to watch very carefully. And then I almost want to link to this, James, what you said. and I fully second that there are not enough bankable projects. That's exactly what we are seeing, we are hearing from big asset managers. Funding is usually not the constraints, it is the lack of projects. I will say, as IFC, we have taken this on in our strategy and expanded our strategy with a theme we call creating markets, where it is exactly engaging much earlier with private sector companies and with our public sector counterparts to remove obstacles, to help develop projects, to help develop circumstances, so to say, that's conducive for developing projects. But that's, of course, medium to long term. This is not necessarily something that will come overnight. So I'm afraid more complexities and dilemmas, but I think it's the first step when we know them.
Thank you, Wiebke, also for your comments. Caroline, let me now go back to that idea of policy predictability. You're connecting from DC, from Washington. There is a new president-elect, not president yet, but president-elect in town. At least if everything goes as expected, President Joe Biden will take office in January. How do you expect this to possibly affect global investment in the years to come, particularly following a presidency like the presidency of Mr. Donald Trump, that has been very assertive on many different topics that obviously affect global trade and investment. So what would you expect? What are your expectations if we look at the next 4 years of President Joe Biden?
Well, maybe looking forward, I think, as I said before, this is a period of wait and see. And it's going to be a competitive market out there. So developing countries trying to bring in foreign investment are going to have to compete for that investment. And as Wiebke mentioned, our investment competitiveness report and other surveys have really shown the importance of macro stability, political stability, but also this kind of regulatory predictability. So I think no matter who's president, countries want to do the same thing. They want to make these reforms. They want to make themselves attractive, and they can use their investment promotion agencies to go out there. You can't just sit and wait in the beauty contest. You also have to be proactive in trying to bring the investors in. And there is money out there. It's a lot of liquidity now. I think there's still this wait and see period, but it is possible, I think, for trade growth to restart. I want to also think back to a period that in some ways was similar to this period we saw here before COVID hit, which is a period of kind of slow trade growth, slowing foreign investment growth, uncertainty about what's going to happen in the trade system. And I'm talking about the late 1980s. In the 1960s, trade grew much faster than income. It still grew faster in the 1970s, and in the 1980s, it had slowed down. There were a lot of NTMs. There was a trade spat between the US and Japan. People really thought it was the end of globalization. Lo and behold, we had the fastest growth in history of trade relative to, or recorded history of trade relative to income. And what brought that about? Technological advances, huge trade agreements, reforming the trade system from the GATT to the WTO, the expansion of the European Union, China joining the WTO. So a lot of things happen. So this period, to me, it's a big disruption. Different things could happen. There could be a decoupling. There could also be a rethink of the trade system. Some countries that have been historically more closed, like an India or a Brazil, could open up, and that could change things, big markets. So I think we're in a period of uncertainty. I think there'll certainly be more predictability around trade policy, but the tensions that exist aren't going to disappear because of a new administration in the US. The one thing, and I think we've talked about this a bit in this discussion, one thing that is going to change is this move towards sustainability. So we are going to see this shift towards more sustainable industries. And it was really interesting to hear James talk about not really seeing it in the plans of countries. I think that will change as policies change. So if we start to see carbon taxes, then clearly, and they hit at the border, then clearly these things are going to loom larger. If we see countries demanding their multinationals behave certain ways, even outside of their own borders, we're going to see different behavior. So big disruption. Wish I had a crystal ball, but I think we'll see some changes.
James, would you agree? Would you agree also to the fact that a new administration in the US doesn't necessarily change the outlook and on these uncertainties overnight?
Well, I'm not qualified to comment on that because I haven't looked into that situation. But it's fascinating to listen to Caroline's perspectives. She's optimistic, and for that, that helps me to rethink of my assessment. I'm a bit of pessimistic, or to see particularly this trends of deglobalization. But she has a point. I think that it's worth reflecting.
Thank you, James. Wiebke, what does it mean for our host country of this digital event, Turkey? You mentioned at the very beginning that you have a life experience. You spent 6 years, if I'm not mistaken, in Istanbul. And Turkey is a country that also testament to the rise of YASED, has been incredibly successful in the past 30 to 40 years in attracting foreign investment and transforming this foreign investment into an opportunity to develop local supply chains and nurture and growth its own industrial base. So when it comes to framing Turkey within this global outlook and the different elements to this global outlook that we have discussed, what can be the lessons for the policymakers in the country?
No, thank you, and thank you for bringing up Turkey also. And I had said perhaps two thoughts first. I think one thing we've seen, and Turkey has had a good story, like I say, a strong story on FDI in the past, supported by the strong investments in the country, and it's very clear that there are a number of, I want to say, strong assets that Turkey has and can keep leveraging. We talked about also the importance of predictability. We've seen with a bit of macro volatility that the country has experienced, that this has an impact on, including on FDIs. What I find interesting, again, with the opportunities that may come from this, in a way, this huge disruption to everyone, every country, and every stakeholder that this brings. I've always thought of sort of Turkey's FDI story so far very much focused on a large domestic consumer market, a strong location, and also a strong integration with the EU, with European countries through the proximity. So I think some questions we can think about going ahead. What will be the key drivers going ahead for Turkey? Will sort of these parameters be still the key driving ones? And I think there is there is a fair chance and a lot of data that supports this, in particular as there's strong mutual interest and ties between European, also US and Turkish companies. And in addition to those, which form a large part also of FDI so far, we see actually that there is, let's say, the strong diversification of sort of countries of origin that are investing in Turkey is another part of the strength and pointing to sort of the future, including a lot of interest from Asia, from the Middle East. So this, I think, that strong diversification to drive forward. The other, and that's something we're observing with a lot of interest, is a focus increasingly on higher value add production, higher value add companies and manufacturing. That type of positioning where the country also shows a lot of potential, including in the tech sector. And this is actually an ecosystem that we see the Turkish authorities have supported a lot, and is really critical to, so to say, retool the economy and a big part of the industry. And the last point I would mention, given the, let's say, given its geostrategic location, as a sort of where it sits between different sort of huge, huge markets, I think, can there be more, can that location be leveraged more, so to say, as a logistics hub, and not only transport logistics, but sort of a much broader ecosystem to develop around sort of logistics. So these are very interesting pointers that sort of, as we look ahead, and I'd say we see that the authorities are also recognizing this, as we see the need for structural reforms being highlighted. We see a strong focus on these critical industrial sectors and also on sustainable infrastructure.
Thank you, Wiebke. Caroline, do you want to add anything on this particular topic?
Yeah, sure. Just maybe to reinforce some of the things that Wiebke said, I think, you know, one is just around Turkey in particular. This is a time, you can also use a crisis as an opportunity for some reforms, and the predictability is very important. And we did see in our survey of investors that there are some legal and regulatory challenges in Turkey. And so addressing those complex administrative procedures and things like that now to make it a little bit easier for investors can be something Turkey can do. Turkey has this tremendous strength in terms of engineering. Some of the best engineers I know come out of Turkey. We see them also as economists, often switching to the economics field and performing fantastically well. And the one sector we do know is going to continue to grow and thrive is the digital and tech sector. So, you know, big opportunities there for the country.
Fantastic. Well, I mean, James, I think that we are just about to get to the very end of this discussion. I would like to close with some considerations on investment promotion. Let's widen the scope of what we have just discussed about Turkey. You at UNCTAD, you have a direct pulse of investment promotion agencies around the world and the kind of activities that they are doing. Obviously, also for them, this has been a big disruption. Obviously, most of these investment promotion activities used to be done by traveling to meet stakeholders, prospective investors, and the other way around, the investors would visit sites, etc. Things have been completely different in the past few months. So as a final remark, I would just ask you, according to your experience, what you have witnessed in the market in the past few months, what are those kind of like set of best practices that will help, provided that countries manage to put up a compelling investment story, what are those best practices that will help boost and enact the compelling investment story across developing and developed countries?
Yeah. Jacopo, yes, we have been interacting with investment promotion agencies worldwide. The best practices to cope with the pandemic and beyond, two-pronged. The first is, of course, response, and that includes aftercare services, investment retention on one hand, and try to encourage those investment projects that's been ongoing and disrupted during the crisis to continue to finish or that to start operating. So this is a kind of a short-term response to the pandemic. In the meantime, considering the longer-term investment strategy, things won't be back to normal, back to the stage of the past. So we do see the longer-term transformation of global value chain and also the behaviors of the investors. So they need to get prepared first to identify the opportunities. The first wave of the opportunities, or when the FDI is on the recovery, will be kind of restructuring-driven, resilience-driven type of business opportunities for investment. So to capture that first wave of investment, including in certain sectors, there may be the capital replenishment, and that may create some opportunities. So diversification and redundancy for resilience could be the first wave. And still longer term wise, we see the sustainability is a drive for green and blue economies investment, for infrastructure, including digital, and also investment in services. That we see this rapid growth of services will have further offshoring. This is contrary to manufacturing value chains. Could be shorter and more geographically concentrated, or more regional, so to speak, than global, because of the drive of regionalization, regional initiatives, but also sustainability imperative for the environmental impact, for transportation. So there are many reasons for multinational companies to diversify, to regionalize, and nearshoring to a certain extent, not very much. I think Caroline explained already, and also replication. That is the distributed manufacturing may have a different implications for countries, and for that, these are opportunities for countries to attract investment. Investment retention become kind of a challenge also for some developing countries because of technology-driven nearshoring, reshoring, or regional replication to advance the countries to a certain extent, so to speak, does that qualify? So I think there are challenges, opportunities for investment promotion agencies worldwide. They need to have new strategies. They need to have a kind of paradigm shift for investment development paths, the GVC development paths.
Okay, that's fantastic, James. So I believe that whatever the case, this crisis, one thing that we can all agree is that really definitely made richer the debate around the global trade and investment. And I think that also this session is testament to that kind of like growing plurality and diversity of this debate. So I would like to close by thanking you all, Ms. Wiebke SCHLOEMER from the IFC, Caroline FREUND from the World Bank and James ZHAN from UNCTAD. I personally believe that this will be defining months for any government across the globe. There will be a lot of public investment going into recovery packages, and that kind of compelling investment story that Wiebke mentioned will be defining also those recovery packages. And depending on whether or not countries will be able to really find their excellences, they will also define the level of success or failure moving forward. So thanks again, and thank you, YASED, for hosting this panel discussion.